Hello and welcome to today's video. Welcome to the latest market update, and wow, do we have a lot to cover today. We will cover performance of classical and crypto market, state of Bitcoin miners, state of companies like Nike, and then for the end we will make comments on macro reports like CPI and unemployment rate. Before diving in, nothing said here is not a financial advice. I am just one guy on the internet showing publicly available data. As it goes for crypto market, March is behind us, and what a month it was. Looking at Bitcoin's quarterly performance, we had the worst first quarter since 2018, with losses exceeding 10%. Ethereum fared even worse, ending the quarter down more than 40%. It felt like a punch to the gut for investors, not the kind of post-halving year we had envisioned. The total crypto market cap has dropped nearly 30% from its recent all-time highs, with cryptocurrencies like Solana and Sui plunging almost 60% from their peaks. Now let's go to the classical market. When we speak about S&P, it dropped 18% from the start of the year and is now trying to find support zone. Major stocks took a hit as well. Tesla plunged more than 40%, Nvidia fell 30%, while Amazon, Microsoft, Alphabet and Meta all lost over 20% during the same period. The big question now, are we near the bottom or is even more weakness ahead? Bitcoin miners, an essential part of Bitcoin network, have been struggling since the start of 2024. Given the current weakness in the market, it's no surprise that buyers are feeling the pressure as well. With that in mind, I decided to compare key miners based on their market cap growth relative to their operational expansion and Bitcoin holdings. Not all miners will be included in this analysis, as some lack the scale or they do not hold Bitcoin. Share dilution is a common occurrence among miners, with no exceptions. However, the key metric to focus on is their total market cap, as it serves as a baseline for comparison. For instance, Iron's market cap has surged by 300% from January 2024 until now, HUD by 240% and TeraWulf by 179%. In contrast, CleanSpark saw a more modest increase of around 49%, while Riot and Marathon remained virtually unchanged. Let's start now by comparing hashrate growth over the same period. The biggest market cap gainer, Iron, also saw the largest hashrate growth, exceeding 360%. However, HUD and TeraWulf had much smaller increases. TeraWulf hashrate grew by just 18%, while HUD actually declined. It's important to note that this analysis only considers self-mining operations, not hosting. Meanwhile, CleanSpark's hashrate surged by 300%, yet its market cap grew at a much smaller rate compared to Iron. Interestingly, CleanSpark currently operates a larger mining fleet than Iron. As for Riot and Marathon, both doubled their hashrate during the same period, yet their market caps remained flat, suggesting potential undervaluation from this perspective. Another interesting trend is the growth of Bitcoin holdings among certain miners. Here I'm focusing only on those with over 10,000 Bitcoins on their balance sheets. CleanSpark stands out, increasing its Bitcoin holdings from 3.5 thousand to just under 12k Bitcoins, a 213% jump. HUD also passed the 10k mark, but their increase was more modest at just 12%. A closer look at their starting point in January 2024 shows they didn't make a strong push to grow their holdings. Meanwhile, Riot and Marathon saw significant growth, up 144 and 195%, now holding 18.7k and 46k Bitcoins respectively. If we take the current Bitcoin price as $80,000, CleanSpark Bitcoin's holdings alone now account for about 47% of its market cap. Riot's Bitcoins makes up around 60% of its market cap, while Marathon is the standout here with an impressive 95% of its market cap is covered by Bitcoin's holdings alone. Despite CleanSpark's strong growth in both hashrate and Bitcoin reserves, its market cap has only seen moderate gains. Riot and Marathon, on the other hand, have maintained similar market caps while also achieving strong growth in both areas. Among all, Iron stands out as a top performer during this period, not for growing its Bitcoin stash, but by diversifying into the AI sector, which has become the key part of their business. Taking all this into account, CleanSpark, Marathon and Riot might be undervalued based on their Bitcoin reserves alone. Iron, on the other hand, could be an interesting pick in the future, especially if the price pulls back as a potential dual play on Bitcoin and AI. Now let's go to the stock market. Nike was already facing negative sentiment even before the latest tariff concerns came into play. Now the stock is taking a hit with recent price action pushing it down to levels not seen since 2020. While many investors are panicking, it's worth taking a step back and looking at some key business fundamentals, specifically Nike's development from 2020 throughout its 2024 fiscal year. Since 2020, Nike's revenue has grown from 37 billion to 51 billion, a 38% increase. Net income more than doubled, rising from 2.5 billion to 5.7 billion, while earnings per share climbed from 1.63 to $3.76. On top of that, the company reduced its long-term debt from 9.4 billion to 7.9 billion, showing improved financial discipline. Also, their share count reduced from 1.56 billion to 1.49 billion during the same period. These are just a few important metrics, but they highlight a strong and consistent performance over the past few years. Given that the current drop in share price doesn't necessarily justify panic, it might present an opportunity. As for tariffs, they appear to be more of a negotiation tactic than a long-term threat. Yes, it may take time for all the parties to reach an agreement, but it's unlikely that any US administration would allow American companies like Nike to suffer prolonged damage. Even under the worst-case tariff scenarios, outsourcing production still offers a significant cost advantage. The average hourly wage in the US manufacturing sector is around $25 to $30, much higher than labor costs abroad. All things considered, it seems the market is currently overreacting. Short-term volatility may persist, but historically, rebounds tend to follow periods of extreme pessimism. This could be one of those moments. Now let's go to the cannabis sector. Green Thumb Industries is another interesting company I keep an eye on. They operate in a sector still grappling with regulatory challenges. That said, their stock is currently trading at levels not seen since 2020. Despite the challenges, the company has shown impressive growth. Revenue has more than doubled from 556 million to 1.1 billion, while net income rose from 15 million to 73 million. Earnings per share increased from 0.07 cents to 0.31 cents, with only a modest rise in share count from 218 million to 236 million. The cannabis industry has never really been in favor with investors, and that hasn't changed. Still, Green Thumb stands out for me. They have managed to achieve consistent profitability, still modest but rare among their peers, which keeps them firmly on my radar. There are also other interesting tech companies worth watching, especially if this drawdown continues. For the end, I will speak a little bit about macro. There is a saying, money goes to money, and in this case it feels like bad news is piling onto more bad news. The unemployment rate came in at 4.2%, marking the third consecutive month of an upward trend. With the current tariff wars underway, there's growing concern about a potential resurgence of inflation. Some analysts warn that if US imposes a 25% universal tariff on all affected countries, and those countries retaliate, the result could be a spike in inflation, potentially pushing it as high as 5%. With upcoming CPI data this week, it will be interesting to see whether we get a hotter than expected print, which could stir up additional volatility in the markets. With all that said, not everything is as bleak as it might seem. Take Vietnam, for example. After the introduction of tariffs, the country signaled its willingness to negotiate with the US. This alone shows the true intent behind these tariffs: to secure better and fairer trade deals for both sides. As a result, companies like Nike, which rely heavily on production in Vietnam, can breathe a little easier. In the long run, these tariffs could help redirect capital back to the US, potentially becoming a net positive for the American stock market over time. It's been a rough start to the year so far, and with the usual seasonal weakness in the summer months ahead, we could be in for a bumpy ride, at least in traditional markets. But this isn't a time to be stressed, it's a time to stay sharp and maybe even excited. After all, fear often sets the stage for the biggest opportunities. And with that, I'm logging out. Until next time, bye.